What is stock market crash? A stock market crash is a sudden decline in the stock prices across a major cross-section of the stock market, which causes a significant loss of paper wealth. There have 5 famous stock market crashes in the world, which are the Great Depression of 1929, Black Monday of 1987, the dot-com bubble of 2001, the financial crisis of 2008, and the recent one, stock market crash 2020. The stock market crash 2020 was a global stock market crash that commenced on 20 February 2020. At the beginning of March, financial markets became highly unpredictable with major fluctuations happening on global markets. Severe contraction in response to the COVID-19 pandemic and the oil price war between Russia and the Saudi Arabia-led OPEC countries. A stock market crash happens as traders are trying to sell their stock portfolio and reducing costs. This can be terrible for investors who hold shares, and a market crash may occur. It occurs for a number of reasons, including bad economic news or other bad news such as a war or terrorist attack, or simply a general sense that the economy is overinflated. The stock market crash 2020 was the result of investors who were worried about the impact of the COVID-19 pandemic. It caused widespread economic and social disruption. As a result of the recent uncertainty, the market-wide circuit breaker that seek to avoid panic trading have been activated 4 times alone in March. The third cause of stock market crash 2020 is an oil price war that broke out several days before the disaster. Oil demand has recently plummeted and decreasing its price. Factories became idle and thousands of flights became cancelled after the spread of the virus became a global pandemic. And then over the weekend, a crash over oil production cut between Saudi Arabia and Russia caused a perfect storm in oil prices. This made the situation much worse. Here are 4 risks that involve in the banking industry due to the stock market crash 2020, which are credit risk, interest rate risk, country risk, and systematic risk. Let us talk about credit risk. Due to stock market crash 2020 occurring, investment market is no longer profitable. The economy is not doing well, which will lead to unemployment rate increases and people not able to make repayment for the loans. Second risk is interest rate risk. Due to stock crash 2020, many country governments had instructed the new interest rate to the banks. They eased monetary policy by cutting policy rates. The effect of reduced the rate will be reinforced through central bank guidance on future path of monetary policy. Third risk is country risk. Due to COVID-19 pandemic, every country's economic condition and political condition not good. This will affect the commercial bank and the bank's interest. Besides, it affects the investment market because the investor lack of confidence to the country, lack of investment, which means the market is not profitable. Systematic risk is also one of the risks. Almost every country facing COVID-19 pandemic, which affect the investment market and the price of the bonds. The macro factors causing the stock market crash 2020 happened. The price of all market instruments is not stable, be a big hit to banking industry. Stock market crash caused by COVID-19 pandemic ranked in the 5th place in the historic market fall. The impact of the stock market crash 2020 on the global banking and Malaysian banking industry are including liquidity crisis, decreasing in net interest margin, affect bank non-performing loan, and affect bank share. The first impact is liquidity crisis. Banks sell assets to pay the liability, which is the withdrawal deposit when many people demand to take out deposit. Depositors also take out the fixed deposit before maturity to face the stock crash, and this unexpected situation make the bank difficult to have many cash to pay to depositor. This will affect the bank asset and bank will face difficulty to operate the bank. Thus, it will affect the bank profitability. The second impact is decreasing in net interest margin. As most of banks lower their interest rate to stabilize the economic market, stock market crisis caused many investors loss in money, and COVID-19 pandemic caused many unemployment in the country. The banks need to cut down their interest rate on borrowing to prevent credit risk. Malaysia Central Bank at first take action to lower down the OPR by 25 basis points to 2.75% on 22nd January, then lower down again to 2.5% on 3rd March, and further lower by 50 basis points to 2% on 5 May, which the lowest rate since year 2009. Stock market crash 2020 also impacted the bank non-performing loan. In April 2020, the unemployment rate increased in many countries. It included Malaysia. This caused them unable to repay the debt to the bank. For example, HSBC UK 2018 annual report showed that loans and advances to customers accounted for £174.8 billion or 73% of £238.3 billion in total assets. This means that HSBC suffer much more from the borrower default on these loans and advances compared with borrowers' investment in stock and bonds that have fallen in value. Lastly, the stock market crash 2020 will impact bank share. Interest rate decrease will indirectly affect the bank stock. Bursa Malaysia reported 9 financial institutions lost total market capitalization for RM61 billion since March 2020 due to the many investors sell stock in the market. These 9 financial institutions included
Next, what are the mitigation strategies to minimize the impact of the crash? So for the first strategy is diversify bank portfolio. Bank management can diversify portfolio by choosing different financial products such as equity, bonds, stock, and mutual funds and choosing the product from different firms, sector, or regions. Second strategy is hedging. Bank can use hedging to reduce the exposure to various risks that change the price of market that will affect bank profit and asset value. The strategy is use one risk to offset another by using the financial derivative such as forward contract, future contract, and options. Options are put options, call options, future options, stock options, and currency options to give the holder the right to manage the financial products so they can react according to the market situations. The strategy asset liability management ALM. ALM help to control the interest rate risk in bank by using the method gap analysis, duration analysis, and duration gap analysis. ALM system is used the method to manage asset and cash flow to help banks prevent mismatch and fulfill their obligations. ALM can help banks track the interest rate difference between deposit interest and loan interest. Thus, if the asset and liability are matched, it can help banks prevent unexpected change in the interest rate. Fourth strategy is stop losses. Stop loss is an order issued by an investor broker to sell security when the price reaches a specific price limit. To this end, the investor pays the broker the cost of placing a stop loss order. Stop order is a tool that can minimize the risk when using it for short-term investment plans and can prevent stock prices from falling. There are two types of stop losses, which is hard stop and trading stop. Other mitigation strategies such as buy insurance, liquidity risk management, and credit risk management can help the bank to minimize not only the stock market crash but also other financial crises. Therefore, banks need to choose the suitable strategy and implement with good planning to ensure can high percent reduce the impact of the crash. Lastly, stock market crash 2020 is a big hit to economic, financial market, and bank industry because the sudden decline in stock price will lead to a lot of negative effect to many sectors. The crash caused the unemployment rate in the country increases. The investment market is no more profitable compared with before the crash. The bank industry faces a lot of losses due to the stock market crash 2020. It was the worst downfall since the 2008 Great Recession at the time.